You have been lied to. The entire architecture of our educational system, our corporate hierarchies, and our cultural narrative is built upon a single foundational deception. The lie is that intelligence, as measured by academic achievement, standardized tests, and intellectual horsepower, is the primary determinant of success. We are taught to worship at the altar of IQ. We are told that the smartest person in the room is destined to win. This is not just an incomplete picture, it is a catastrophic misdirection, a psychological virus that has led more brilliant minds to financial ruin than any other single factor in human history. The evidence for this is not subtle. It is a multi-trillion-dollar graveyard of failed geniuses, a testament to the fact that a high-powered cognitive engine without the right psychological chassis will invariably fly off the road at the first sharp turn. In the world of high-stakes decision-making, and particularly in the arena of wealth creation where emotion and uncertainty reign supreme, your IQ is not your greatest asset. It is your most profound liability. A powerful intellect, untethered from a superior temperament, does not lead to better decisions. It leads to more intricate, more creative, and more spectacularly destructive rationalizations for terrible, emotionally driven decisions. The genius does not simply make a mistake. They construct an elegant, mathematically sound, Nobel Prize-winning thesis to justify their own self-immolation. And there is no greater story, no more terrifyingly perfect case study of this phenomenon than the rise and cataclysmic fall of a small, obscure hedge fund that came closer to breaking the global financial system than any entity before or since. It was called long-term capital management, and its story is not a lesson in flawed financial modeling. It is a deep, chilling exploration of the psychological weakness that lives inside every intelligent, ambitious person. It is the story of what happens when the smartest brains in the world are handed a loaded gun. The year is 1994. In a quiet, unassuming office in Greenwich, Connecticut, a financial supernova is born. Long-term capital management, or LTCM, was not just another hedge fund. It was the financial equivalent of the Manhattan Project, a gathering of intellectual titans so formidable it seemed less like a company and more like a law of nature. At its helm was John Meriwether, the legendary former head of bond trading at Salomon Brothers, a man whose intuition for the market was considered almost supernatural. But it was his partners who truly defined the firm's aura of invincibility. The roster included David Mullins, a former vice chairman of the Federal Reserve. It included Robert Merton and Myron Scholes, who just 3 years later in 1997 would stand in Stockholm to receive the Nobel Memorial Prize in Economic Sciences for their work on the Black-Scholes model, the mathematical formula that unlocked the pricing of options and derivatives and became the bedrock of modern quantitative finance. This was not a team, it was a pantheon. They were the high priests of financial science, the men who had written the textbooks, who had decoded the secret language of the markets. Their strategy was, on the surface, the epitome of intellectual elegance. They believed that with enough data and enough computational power, they could identify tiny, temporary mispricings in the global bond markets, statistical anomalies, fleeting deviations from the rational order they knew must exist. They would engage in what were called convergence trades. For example, they might observe that a newly issued 30-year U.S. Treasury bond was trading for a fraction of a penny less than a 29.5-year Treasury bond. In a rational world, these two instruments should be virtually identical in price. The tiny difference was a market inefficiency, a flicker of irrationality. LTCM's models, running on powerful Sun Microsystems workstations, would spot this discrepancy and place a gargantuan bet that the prices would, inevitably, converge. They would go long the cheaper bond and short the more expensive one, waiting for the universe to correct itself. The problem, of course, was that these price differences were minuscule, often just a few basis points. To generate the spectacular returns their investors demanded, they couldn't just make the bet, they had to make it with an astonishing amount of borrowed money. Leverage. For every $1 of their own capital, they would borrow $25, $30, sometimes even $50 more. This leverage acted as a massive amplifier. A tiny 1% profit on the underlying assets would become a staggering 25 or 50% return on their capital. For 4 years, the machine worked with terrifying precision. It was a license to print money. Their returns were astronomical: 21% in their first year, 43% in their second, 41% in their third. They were the envy of Wall Street, a black box of pure genius that seemed to have solved the fundamental problem of risk. They had, in their minds, transcended the messy, emotional fray of investing and elevated it to a pure science, like physics or astronomy. Their confidence, fueled by a torrent of profits and the adulation of the financial world, hardened into something far more dangerous: cognitive hubris. They believed their models were not just representations of reality. They believed they were reality. Their Nobel Prizes were not just accolades. They were proof that they were operating on a higher intellectual plane, immune to the primitive fears and panics that governed lesser mortals. They weren't just smarter than everyone else. They were fundamentally different. In their Greenwich headquarters, they built a fortress of intellect, a sealed cognitive environment where their own assumptions were never seriously questioned. When asked about the possibility of a catastrophic loss, one of the partners famously remarked that the odds of such an event were so low that it would require a 10 sigma event, a statistical impossibility that was not expected to occur in the entire lifespan of the universe. They had used their genius not to build a margin of safety, but to mathematically prove to themselves that they didn't need one. They had become the easiest people to fool. Then, on August 17, 1998, on the other side of the planet, the universe failed to follow their equations. Russia, struggling with its transition to a market economy, defaulted on its domestic debt and devalued the ruble. It was a seismic shock, a political and economic event that their models, which were based on historical market data from stable Western economies, had never contemplated. Suddenly, the rational, orderly world they had built their empire upon ceased to exist. In the ensuing global panic, a flight to quality began. Investors around the world didn't care about the subtle pricing differences between a Danish mortgage bond and a German government bond. They didn't care about statistical arbitrage. They wanted one thing and one thing only: the safest, most liquid asset on earth, U.S. Treasury bonds. They sold everything else to buy them. This was the one scenario LTCM's models had deemed impossible. Instead of converging, the prices of the assets they held blew apart. The tiny, rational spreads they had bet on became gaping, irrational chasms. And with every tick of the market, their leveraged positions were hemorrhaging billions. The geniuses were trapped. Their models told them that the market was being irrational, that their positions were now theoretically more correct and more profitable than ever. Their intellect screamed at them to hold on, to even double down, because science dictated that the world would eventually return to its senses. But they had forgotten the most important rule of the market, a rule famously articulated by John Maynard Keynes. The market can remain irrational longer than you can remain solvent. Their leverage, once the engine of their success, had now become a doomsday device. Their lenders, the biggest banks on Wall Street, began to issue margin calls, demanding more collateral for the loans that backed their trades. But LTCM had no more collateral. In the space of just 5 weeks, the firm lost $4.6 billion. 90% of its capital was wiped out. The 10 sigma event, the statistical impossibility that was never supposed to happen, had happened. The financial supernova was collapsing into a black hole, and its gravitational pull threatened to tear the entire global financial system apart. The potential failure of LTCM was so catastrophic, its position so large and interconnected with every major bank, that the president of the Federal Reserve Bank of New York, William McDonough, had to orchestrate an unprecedented $3.6 billion bailout, forcing 14 of Wall Street's biggest firms to prop up their failed competitor to prevent a chain reaction of global defaults. The smartest men in the room had not only failed, they had failed so spectacularly that they had nearly taken the rest of the world down with them. The post-mortem of long-term capital management is not a story about bad luck or a flawed algorithm, it is a psychological autopsy. It reveals, with chilling clarity, the three fundamental cognitive traps that high IQ individuals are uniquely susceptible to. These are not flaws in their intelligence. They are flaws that are amplified and weaponized by their intelligence. They are the hidden viruses in the mental operating system of the ambitious, and understanding them is the first, critical step in building an immunity. The first and most lethal of these traps is cognitive hubris. This is a particularly virulent strain of overconfidence that infects the intellectually gifted. It is the baked-in belief that superior intelligence grants you a special immunity from the emotional biases and psychological frailties that plague the average person. The team at LTCM didn't just think they were smart. They believed their intelligence made them functionally invincible. Their mathematical models were not tools to be questioned. They were scripture. This is the core danger of a high IQ. It doesn't prevent you from being wrong. It simply makes you more skilled at being wrong with confidence. A person with average intelligence who makes an emotional decision might feel a pang of doubt. A genius who makes an emotional decision will construct a multivariate regression analysis, write a 60-page white paper, and backtest it against 20 years of data to prove to themselves and the world why their emotional impulse was, in fact, a stroke of unparalleled brilliance. They become masters of sophisticated self-deception. Their intellect is no longer a tool for discovering truth. It is a weapon for defending their ego. This is the Dunning-Kruger effect raised to the level of high art. They are so competent in their narrow field of expertise that they become blind to the vastness of their own ignorance in other domains. Domains like market psychology, human panic, and the brutal, non-linear nature of real-world risk. They confuse academic intelligence with what the investor Howard Marks calls second-level thinking, the ability to think about the thinking of others, to anticipate the role of emotion, and to understand that the market is not a machine but a complex, adaptive system driven by a sea of human fear and greed. The second psychological trap is the action imperative. Society, and especially corporate and academic environments, rewards activity. We are conditioned from a young age to believe that doing something is always better than doing nothing. For intelligent and ambitious people, this conditioning is particularly potent. Their self-worth is often tied to their output, their ability to solve problems, to tinker, to optimize, to act. The idea of sitting still, of patiently waiting for a rare opportunity, feels like a dereliction of duty. It feels unintelligent. This creates a constant, nagging pressure to transact, to rebalance, to find the next clever trade. The market becomes a stage upon which they must constantly perform their intelligence. This bias is lethal in investing, an arena where the vast majority of activity is counterproductive. It is a domain where immense wealth is created not by constant motion, but by occasional decisive action, followed by long periods of profound inaction. The team at LTCM was a perfect embodiment of this imperative. Their entire strategy was based on high-frequency, complex activity. They were constantly tweaking their models, entering and exiting thousands of positions, managing a portfolio of such dizzying complexity that it defied easy comprehension. They could not simply buy a good business and wait. That was too simple, too passive. Their genius demanded a more active expression. They fell victim to the illusion of control, believing that their constant adjustments were reducing risk when, in fact, they were simply multiplying the points of potential failure. Finally, there is the complexity bias. This is the subconscious and often conscious preference for complex solutions over simple ones. To the highly intelligent mind, complexity is seductive. It is a validation of one's own intellectual prowess. A simple solution feels unsatisfying, almost insulting. If the answer is that easy, anyone could have figured it out. Therefore, a truly brilliant mind must seek out and construct intricate, elegant, and often fragile solutions. The Black-Scholes model itself is a thing of mathematical beauty, a testament to the power of abstract reasoning, but its elegance masked a fatal flaw. It relied on a set of simplifying assumptions about the world, that volatility is constant, that price movements are random and follow a normal distribution, that markets are liquid. In the real world, none of these things are true. Volatility is itself volatile. Price movements have fat tails, meaning extreme events happen far more frequently than the models predict, and in a panic, liquidity can evaporate in an instant. LTCM built their entire worldview on a beautiful, complex theory and were destroyed by a messy, simple reality. They chose the elegant map over the rugged territory. Their preference for complexity blinded them to a simpler, more robust truth. That extreme leverage, no matter how intelligently applied, creates an unacceptable risk of ruin. A child could understand that borrowing $50 for every one you own is dangerous. It took a room full of Nobel laureates to prove to themselves that it was safe. This psychological trifecta, cognitive hubris, the action imperative, and the complexity bias, is the blueprint for high IQ failure. It is a closed loop of self-destruction. Hubris convinces you that you are immune to error. The action imperative compels you to constantly make bets. And the complexity bias ensures that those bets are intricate, fragile, and impossible to fully understand. This is the operating system that led the smartest men in the room to financial oblivion. And it is the precise operating system that another man, sitting in a quiet office in Omaha, Nebraska, had spent his entire life systematically identifying and uninstalling from his own mind. That man, of course, is Warren Buffett. His entire $90 billion fortune is not a product of a superior intellect, but of a superior psychological framework designed explicitly to counteract these self-destructive tendencies. When asked about the failure of LTCM, Buffett's diagnosis was simple and devastating. He said to make money they didn't have and didn't need, they risked what they did have and did need. That is foolish. It is just plain foolish. And if you risk something that is important to you for something that is unimportant to you, it just does not make any sense. Notice his language. He didn't say their math was wrong. He didn't say their models were flawed. He said their decision was foolish. He identified the failure not at the level of intellect, but at the level of wisdom, of character, of what he considers the single most important quality in investing: temperament. This is the core of the Buffett operating system, the great inversion. While the rest of the world is obsessed with finding the smartest person, Buffett is obsessed with finding the most rational person. He has stated unequivocally that the most important qualities for an investor are, quote, temperament, not intellect. He says, quote, you don't need to be a rocket scientist. Investing is not a game where the guy with the 160 IQ beats the guy with the 130 IQ. Rationality is essential. This is not a folksy aphorism. It is the central thesis of his life's work. He understood, earlier and more deeply than almost anyone, that the battlefield of investing is not the stock market. It is the 6 inches of space between your own ears. Your greatest enemy is not a competitor or a bad economy. It is your own emotionally hijacked mind. And so, he did not dedicate his life to becoming a better predictor of the future. He dedicated his life to architecting a psychological fortress within himself, a system of mental models and cognitive protocols designed to insulate his decision-making process from the destructive emotions of fear, greed, and, most importantly, the ego-driven hubris that comes with being smart. This is what we are here to deconstruct. Not another set of financial tips, but the deep psychological architecture of Buffett's temperamental fortress. This is not a personality trait you are born with. It is a system you can build. It is an operating system you can install. And it is built upon 3 foundational pillars, 3 master protocols that, when combined, create a state of supreme emotional detachment and rational clarity. These pillars are the architect of detachment, the time arbitrager, and the humility engineer. Understanding and installing these 3 pillars is the work of a lifetime. It is the process of transforming your mind from a liability into an impenetrable fortress. Pillar 1, the architect of detachment, the Mr. Market Protocol, *. The first and most critical pillar of the temperamental fortress is the construction of a bulletproof psychological firewall between your own mind and the manic-depressive insanity of the market. The human brain is a social organ. It is wired for mimesis, for conformity, for taking its cues from the tribe. When the crowd panics, our amygdala lights up, flooding our system with cortisol and adrenaline, screaming at us to sell, to flee, to follow the herd off the cliff. When the crowd is euphoric, our brains release dopamine, urging us to join the party, to buy at any price, to abandon all discipline for fear of missing out. This is not a character flaw, it is our evolutionary hardware. Left to its own devices, your brain will force you to buy high and sell low, forever. Buffett understood this fundamental problem of human nature. He knew that willpower and intelligence were insufficient defenses against these deep-seated biological urges. You cannot simply command yourself not to feel fear or greed. So he engineered a cognitive tool, a mental model so powerful that it effectively rewires the brain's response to market volatility. He created a psychological construct, an imaginary character, to absorb all the market's irrationality so that he wouldn't have to. He called him Mr. Market. We have discussed this concept in a previous documentary, but we must revisit it now through the specific lens of temperament. The Mr. Market allegory is not a cute story. It is a profound act of psychological engineering. It is a technique for cognitive reframing, for what psychologists call decentering. Here is the model, as Buffett first learned it from his mentor, Benjamin Graham. Imagine that you are a partner in a private business, and you have only one other partner. His name is Mr. Market. Every single day, without fail, Mr. Market shows up at your door and offers to either buy your share of the business or sell you his share. The defining characteristic of Mr. Market, however, is that he is a manic depressive. Some days he arrives in a state of wild euphoria. He sees nothing but a glorious future for the business and offers to buy your share at an absurdly high price. On other days he is suicidal. He is consumed by pessimism and despair, convinced the business is on the verge of collapse. On these days he begs you to take his share off his hands for pennies on the dollar. The critical insight is this: Mr. Market is there to serve you, not to guide you. You are free, every single day, to either accept his offer or to completely ignore him and go about your business. His emotional state has zero bearing on the underlying reality of the business you co-own. His quotes are not a reflection of the business's intrinsic value. They are a reflection of his own psychological turmoil. Now let's analyze the deep psychological work this model is doing. By personifying the market, by giving it a name and a personality, Buffett performs a brilliant act of externalization. The market is no longer an all-knowing, objective force. The market is down today. It is now Mr. Market is in one of his moods again. The fear and greed are no longer your own. They belong to him. He is the one who is panicking. He is the one who is euphoric. You are the calm, rational business owner, observing his antics with a detached amusement. You have created a psychological buffer, a cognitive firewall. His emotional state cannot infect yours because you have defined him as inherently irrational. You would never let a manic-depressive business partner dictate your own emotional state, so why would you let the stock market? Installing this protocol requires a conscious and continuous effort. It is a form of mental rehearsal. When you look at a stock ticker and see a sea of red, you must actively say to yourself, Mr. Market is in a panic today. He's offering me some wonderful businesses at foolish prices. I should take a look at his offers. When the market is soaring and everyone is bragging about their gains, you must tell yourself, Mr. Market is euphoric. He's offering to buy my businesses for more than they're worth. I don't have to sell, but it's interesting to see what he's willing to pay. This is not just positive self-talk. This is the deliberate running of a cognitive program. You are actively reframing external stimuli to trigger a rational response instead of an emotional one. You are creating what psychologists call an implementation intention. The format is, if X happens, then I will do Y. For the Buffett-trained mind, it becomes, if the market plunges X, then I will view it as Mr. Market offering me bargains Y. This active detachment is the foundational skill of the master investor. It allows you to transform volatility from a source of terror into a source of opportunity. The very thing that bankrupts the emotionally fragile investor becomes the primary raw material from which the temperamentally sound investor builds their fortune. They are playing a different game. While others are reacting to Mr. Market's mood swings, the master investor is calmly assessing the underlying value of the business. Their sense of worth and their judgment of value are derived from an internal source, their own research, their own analysis, their own inner scorecard. The external noise from Mr. Market is just that, noise. It is information to be used if it is advantageous, and to be completely and utterly ignored if it is not. The team at LTCM had no such firewall. They saw the market not as a manic partner, but as a rational machine that had temporarily broken. Their ego was fused with the market's judgment. When the market moved against them, it was not just a financial loss, it was an intellectual invalidation. They were being told they were wrong, and their hubris could not accept that. They were psychologically incapable of detaching. They were in a constant, desperate dialogue with Mr. Market, and his panic became their panic. The first pillar of their fortress was non-existent. Pillar 2, the time arbitrager, the patience protocol asterisk. If the first pillar creates emotional distance, the second pillar creates temporal distance. It is a radical re-engineering of your relationship with time itself. Our modern world, and particularly the world of finance, operates on an accelerated timescale. We are drowning in quarterly earnings reports, high-frequency trading algorithms, 24-hour news cycles, and real-time portfolio trackers. This relentless immediacy hijacks our brains, forcing us into a state of short-term reactive thinking. It activates the primitive, anxious parts of our mind that are obsessed with immediate threats and rewards. It is the psychological equivalent of trying to drive a car by staring at the patch of asphalt directly in front of the hood. Buffett's temperament is built on a profound rejection of this temporal myopia. He has engineered his mind to operate on a completely different clock. He is not a stock trader, he is a business owner, and he thinks in the timelines of a business owner which are measured in decades, not days. This is not simply a preference, it is a strategic weapon. He engages in what can only be described as time arbitrage, the practice of exploiting the market's obsession with the short term to capture the immense value that is only created over the long term. How does one install this protocol? It begins with a fundamental shift in perspective, cemented by a powerful thought experiment that Buffett often proposes. Before you buy any stock, you must ask yourself this question: would I be happy to own this business if the stock market were to shut down for the next 10 years? This is not a rhetorical question. It is a diagnostic tool designed to instantly reveal whether you are thinking like an investor or a speculator. A speculator buys a stock because they think the price will go up next week or next month. The idea of the market closing for 10 years is terrifying to them because their entire thesis is dependent on having a liquid market in which to sell to someone else at a higher price. They are dependent on Mr. Market's mood improving. An investor, on the other hand, is buying a piece of an actual business. They expect to make money not from the fickle sentiment of the market, but from the future earnings power of that business. If you are buying a piece of Coca-Cola, you are buying a claim on the future profits generated by billions of people around the world buying and drinking their products. If the market were to close for 10 years, it would be of little concern. The business would continue to operate, continue to grow, continue to gush cash. The underlying economic reality would be unaffected. This single question forces you to shift your focus from the stock price, Mr. Market's quote, to the business value, the economic engine. It is a mental kill switch for short-term thinking. The second component of the patience protocol is the deep, intuitive understanding of the power of compounding. Intellectually, everyone knows what compounding is. but very few people can feel it in their bones. Our brains are linear processors. We are good at understanding what happens when you add 10 to itself 100 times. We are terrible at understanding what happens when you multiply 1.1 by itself 100 times. The explosive, backloaded nature of exponential growth is deeply counterintuitive. Buffett's genius was to make this mathematical abstraction a core part of his psychological reality. He famously made 99% of his net worth after the age of 50. His entire life has been a testament to letting the snowball of capital roll down a very long hill. To install this mindset, you must fight your brain's linear programming. This requires visualization and mental reframing. Stop looking at your portfolio's daily or monthly performance. Instead, create a spreadsheet that projects its value at a reasonable rate of return over the next 30 or 40 years. Look at the numbers in the final decades. See how the growth in a single year in the future dwarfs the entire principle you started with. This is not about predicting the future. It is about training your brain to appreciate the scale of the prize you are playing for. It is about making the long-term reward so vivid, so psychologically potent, that it dwarfs the short-term allure of tinkering or chasing a hot trend. This rewires your brain's dopamine system. The pleasure hit no longer comes from making a trade. It comes from the act of patiently doing nothing, knowing that you are allowing a powerful, silent force to work its magic on your behalf. Patience for Buffett is not passive waiting. It is an active, disciplined, and often painfully difficult strategy. It is the temperament to sit for years with cash, waiting for the perfect pitch, while others are swinging at everything. It is the temperament to buy a wonderful business and then do nothing for decades, resisting the urge to take profits or rebalance. The partners at LTCM, driven by the action imperative, had no capacity for this kind of patience. Their models were designed to capture fleeting, microscopic opportunities. Their time horizon was measured in milliseconds. They were playing a game of speed and volume, while Buffett was playing a game of time and compounding. They were sprinting a marathon, and they were destined to burn out. Patience is the ultimate arbitrage because it is the one resource that the institutional, career risk-averse, quarterly performance-driven world of professional finance is structurally incapable of deploying. By simply adopting a longer time horizon, you are playing a game that very few of your competitors can even enter. You are removing yourself from the frantic zero-sum competition of the present and entering the calmer, positive-sum game of the future. Pillar 3, the humility engineer, the circle of competence protocol, asterisk. The third and final pillar of the temperamental fortress is the one that directly counteracts the most dangerous psychological poison for the intelligent, hubris. This pillar is the active, relentless, and disciplined engineering of intellectual humility. In the Buffett operating system, this is formalized through the mental model of the asterisk circle of competence. Again, we have explored this concept before, but we must examine it now as the behavioral output of a specific temperament. The idea is deceptively simple. Every individual, through study and experience, develops a circle of knowledge. Inside that circle are the businesses and industries you understand deeply. Outside that circle is everything else. The rule of the game is brutally straightforward. You must only ever invest inside your circle. You must never, under any circumstances, venture outside of it, no matter how tempting the opportunity may seem. This sounds like common sense, but it is one of the most frequently violated principles in all of investing, and it is the highly intelligent who violate it most often. Why? Because their intellect convinces them that they can learn anything quickly. They mistake a superficial academic understanding of a new industry, like technology or biotechnology, for a deep, intuitive, operational understanding. Their ego finds it difficult, if not impossible, to say the three most important words in investing: I don't know. Buffett's temperament is different. He has engineered his ego to derive its satisfaction not from the breadth of his knowledge, but from the depth and honesty of his self-assessment. For him, the act of defining the perimeter of his circle is not an admission of weakness, it is his primary source of strength. It is the master filter that eliminates 99% of all potential mistakes before they can even be considered. He famously avoided the entire dot-com bubble of the late 1990s. He was publicly mocked as a dinosaur, a relic who didn't get it. His refusal to invest in technology stocks was seen as a sign that he had lost his touch, but Buffett's reasoning was simple and unshakable. It wasn't that he thought the technology companies were bad businesses. It was that he knew, with absolute certainty, that he did not know how to value them. He couldn't confidently predict what they would be earning in 10 or 20 years. They were outside his circle, so he did nothing. He was not making a prediction that the bubble would burst. He was making a statement about the limits of his own understanding. This is a profound act of intellectual honesty. He was willing to look foolish in the short term to avoid being proven a fool in the long term. Engineering this level of humility requires a specific set of mental protocols. First, you must define your circle not by what you are interested in, but by what you can predict. The test is not, can I understand what this company does? The test is, can I, with a high degree of confidence, project this company's cash flows over the next decade? This is a much higher bar, and it requires a level of expertise that can only be built through years of focused study or direct experience. Second, you must learn to weaponize ignorance. You must rewire your brain to see the phrase "I don't know" as a source of power. Every time you say it, you have just saved yourself from a potential catastrophe. Every investment opportunity that comes across your desk should be placed in one of two buckets: inside my circle or too hard. The too hard bucket should be by far the larger of the two. This is not laziness, it is discipline. It is the conservation of your most precious resources, your capital, and your cognitive energy. You are waiting for the one pitch that is right in your sweet spot, the one that you can hit out of the park. This is the ultimate antidote to the complexity bias that destroyed LTCM. The Nobel laureates believed that their circle of competence was the entire universe. Their mathematical tools, they thought, could be applied to any asset, in any market. They saw the world as a nail because the only tool they had was a beautiful, complex hammer. They had no too hard pile. Their hubris made them incapable of admitting ignorance. They ventured into the esoteric corners of Danish mortgage bonds and Italian government debt, armed with theories that had never been tested in a real-world crisis. They lacked the humility to recognize that the world was infinitely more complex, random, and human than their models could ever capture. They operated with the arrogant assumption that what they didn't know couldn't hurt them. Buffett, by contrast, operates with the paranoid assumption that what he doesn't know is the only thing that some can hurt him. This is the temperamental difference between genius and wisdom. Genius is about finding the right answers. Wisdom is about avoiding the wrong questions. These three pillars, the architect of detachment, the time arbitrager, and the humility engineer, form the unshakable foundation of the temperamental fortress. They are not separate ideas. They are a deeply interconnected system. Your ability to be patient, Pillar 2, is entirely dependent on your detachment from Mr. Market's daily chatter, Pillar 1. Your ability to stay within your circle of competence, Pillar 3, is a manifestation of the long-term patience that prevents you from chasing hot trends outside your expertise, Pillar 2. And your ability to remain detached from the market's panic, Pillar 1, is reinforced by the deep confidence you have in the businesses you own, a confidence that only comes from staying within your circle, Pillar 3. Together, they create a virtuous cycle of rationality, a self-reinforcing loop that insulates the mind from the primary drivers of investment failure. Naimine, Jada Part 3, The Installation, Forging Your Own Fortress. Understanding this architecture is the first step, but knowledge without action is useless. The final and most crucial stage is the installation. How do you, an intelligent and ambitious individual, systematically build this fortress within your own mind? It is not a matter of flipping a switch, it is a matter of practice, of deliberate training, of installing new habits of thought. Here is the actionable blueprint. First, you must begin a asterisk decision and emotional audit DECIS. This is the most powerful tool for self-awareness in the realm of decision-making. Get a physical journal. Every time you make a significant investment decision, buying or selling, you must record not just the logical reasons, but your emotional state. Write down the date, the asset, the price, and the quantitative thesis. But then, you must answer a different set of questions. What is the dominant narrative in the news right now? Am I feeling fearful or greedy? Am I feeling the pressure of missing out, FOMO? Am I making this decision to prove something? Am I bored and just looking for action? Be brutally honest with yourself. Over time, this journal will become your personal psychological X-ray. You will begin to see the patterns in your own irrationality. You will identify the specific emotional triggers that lead you to make poor decisions. This feedback loop is the foundation of self-correction. You cannot fix a bug in your mental operating system until you can identify it. The LTCM partners never kept such a journal. If they had, they might have noticed that their decisions were increasingly driven by ego and the need to justify their own genius, rather than by a sober assessment of risk. Second, you must engage in aggressive asterisk cognitive environment design. Your brain is constantly being shaped by the information it consumes. If you feed it a steady diet of financial news, stock market predictions, and hot tips, you are training it for short-term, reactive thinking. You are voluntarily inviting Mr. Market to live inside your head. To build a fortress, you must create a clean room for rational thought. This means going on a radical anti-news diet. Unsubscribe from market newsletters. Delete the stock tracking app from your phone. Turn off CNBC. Stop reading market forecasts. They are entertainment, not information. Your goal is to create an environment of informational scarcity. You want to replace the fire hose of low-quality short-term noise with a slow drip of high-quality long-term signal. Your information diet should consist almost exclusively of annual reports, industry journals, and books, sources that deal with the fundamental reality of businesses, not the fleeting sentiment of markets. This environmental control is not a sign of weakness, it is a sign of strategic intelligence. You are recognizing that your willpower is a finite resource, and it is far easier to control your environment than to constantly fight temptation. Third, you must proactively build emotional resilience through *domini stress testing via stoic inversion. Your temperament will not be tested when markets are calm. It will be tested in the crucible of a panic. You must prepare for this moment in advance. The ancient Stoic philosophers had a practice called premeditatio malorum asterisk, the premeditation of evils. This is the practice of vividly imagining worst-case scenarios. Applied to investing, this means regularly running a fire drill in your mind. Take your portfolio and imagine its value is cut in half tomorrow. Don't just think about the number. Feel the feeling. Feel the panic, the regret, the urge to sell everything. Walk through what you would do. By repeatedly exposing yourself to this scenario in your imagination, you build psychological calluses. You desensitize yourself to the shock. When the real crisis inevitably arrives, it will not be an unfamiliar terror. It will be a scenario you have already rehearsed. You will have a plan. This practice inverts the normal human tendency to avoid negative thoughts. Instead, it harnesses them as a tool for building strength. It is the mental equivalent of a vaccine, a small, controlled exposure to a threat that builds a powerful immunity. The installation of this three-part system, the audit, the environment design, and the stress testing, is the practical work of building your temperamental fortress. It is a slow, deliberate process of rewiring your own mind. It is the conscious decision to choose the rationality of the inner scorecard over the validation of the crowd. It is the understanding that in the game of wealth, the tortoise who has mastered his own psychology will always, eventually, lap the hare who is a slave to his own brilliance. The story of long-term capital management and the philosophy of Warren Buffett represent a fundamental fork in the road for every ambitious person. One path is the path of intellect, of complexity, of ego. It is a seductive path. paved with the promise of quick, brilliant victories. But it is a path that, for almost all who travel it, ends in the abyss of ruin. The other path is the path of temperament, of simplicity, of humility. It is a slower, less glamorous path. It requires patience, discipline, and the courage to look foolish in the short term. But it is the only path that leads to the kind of sustainable, generational wealth that is built not on the shifting sands of market sentiment, but on the bedrock of unshakable rationality. Building this temperamental fortress is the great work. It is the ultimate defense against the most dangerous enemy you will ever face, yourself. It is the system that allows you to remain calm and rational when the world around you descends into madness. It is the master algorithm that protects you from your own worst instincts, the fear, the greed, the hubris, the impatience. It is the psychological architecture of invincibility. But even with the most perfectly constructed fortress, even with the temperament of iron, there is one final, insidious danger that can lay waste to all your efforts. It is the danger that you cannot see, the risk that is hidden in plain sight, celebrated as genius in good times, and revealed as suicidal folly only when it is too late. It is the risk taken by the smartest men at LTCM, the single factor that amplified their temperamental flaws into a weapon of mass financial destruction. Leverage, hidden risk. It is the invisible current beneath the calm surface of the water. And mastering your temperament is what gives you the clarity to see those currents, to understand that the greatest rewards often come not from taking great risks, but from systematically avoiding the hidden ones that can guarantee ruin. Warren Buffett has a simple, terrifyingly vivid mental model for this exact problem. He said, "It's only when the tide goes out that you discover who's been swimming naked." This single sentence is a complete cognitive operating system for diagnosing the invisible leverage and fragility that builds up in any system, in a company, in a portfolio, and in your own financial life during the euphoric highs of a bull market. That tide will always, inevitably go out, and having the right temperament is what keeps you from stripping off your clothes and diving in during the party. That concept of diagnosing hidden risk before the tide goes out is a critical mental operating system in itself. It is the final layer of your psychological armor, and we have deconstructed that exact framework in our deep dive documentary on Buffett's Swimming Naked principle. If you are ready to learn how to spot the invisible leverage that destroys even the smartest investors, to build a system of true resilience against the inevitable chaos of the market, then you must understand this final piece of the puzzle. Click the video on your screen right now. It is the next critical step in building true financial invincibility.